Hi, everyone. Good afternoon. Thank you so much for joining us this Thursday afternoon. My name is Min, and today my colleague Yulin and I will be sharing with you some exciting updates taking place for the ESG portfolios. We launched the current ESG portfolios in March of 2021, and Endowus was the first to launch these multi-asset portfolios that were focused on ESG. Since then, we've seen more and more ESG funds being made available to retail investors in Singapore, as more and more fund managers realized that the investment community in Singapore and in larger Asia was willing to focus more on sustainable investing. This then gave us more flexibility to further refine our ESG offerings. We'll go into more details on this in the later part of the presentation. Next slide, please. This next slide is just a disclaimer letting you know the presentation is for information purposes only and should not be taken as an offer, solicitation, or advice. Next slide. We want to keep the session as interactive as possible and also make sure that the presentation is actually helpful for you. So please go into Slido. The link is shown here. You can type in the code and you can ask all the questions that you want on the presentation, the portfolios, or even just ESG in general. Next slide. Many of you joining us today are already familiar with Endowus, but for those of you who are new and joining us for the first time, we are a digital wealth advisor. That is different from a robo-advisor where all the advice generated and given comes from an optimizer and an algorithm. With us, your experience is digital, but your advice is available at your fingertips via the app. But it is all thoughtfully put together by our team of investment experts and knowledgeable client advisors. Next slide, please. We have been fortunate enough to have been backed by some of the largest and most well-known names in the industry. They trust us to deliver, and we hope that you will as well. And you can see all the names listed on the left-hand side, from UBS to Citi to MUFG, Samsung, EDBI, Singtel, Lightspeed, SoftBank, etc. So I'm not going to list all of them, but I'm sure many of you are familiar with these names. Next slide, please. Before we get started on the actual recommended portfolio changes, I wanted to just provide a bit of background and an update on Endowus and our own sustainable investing journey. We signed on as a UNPRI signatory in July of 2022. What does that mean? It means that we are committed to incorporating environmental, social, and governance factors into our investment decision-making process, so ESG factors. By becoming a signatory, we agree to uphold 6 principles that promote responsible investment, aim to improve long-term returns, and contribute to sustainable global financial systems. Next slide, please. As part of this, we have developed a classification system for us to use and for our clients. We think that it will be useful for our clients as well, for ESG-focused funds that will probably be useful when you're trying to select funds that better align with your values and objectives. At the beginning of the due diligence process, what we do is we ask the fund manager the objective of the fund. Number 1, are they primarily trying to improve the risk-adjusted returns of the fund by integrating ESG factors? Number 2, are they hoping to bring about positive change, create an impact? Is that the primary objective? So you can go either path 1, which is more risk and return related, or path 2, which is more values and impact driven. But of course, the third possibility is that the manager has a dual objective, which is to improve risk-adjusted returns and also create positive change. Depending on their objectives and the intention of the fund managers, we will assess and evaluate the funds differently. So we don't want to assess and evaluate a fund based on what we think they should be doing, but we want to measure it based on what they think they should be doing. So if the intention is just to improve returns, then we will be assessing just on that. Next slide, please. The flow chart, this is a pretty complex chart, so I'll try to break it down into 2 parts. The first part, we will focus on the right-hand side, which is the flow chart. and it shows how we try to further classify the strategies. We talked about the return and risk path or the values and preferences path. The strategies that focus on risk and return often integrate ESG considerations into their processes. And if you're an investor who is more focused on returns and believes that ESG can really enhance performance, you would most likely want to invest in a fund that has ESG integration as its main approach. Those who are looking to align their values and preferences, so the second path, such as combating climate change, improving communities, you can consider funds that focus on impact. And usually under these, we classify them into three main branches. The first is thematic. For example, Sharia funds, gender diversity funds, climate change funds will be classified as thematic under this particular framework. Transition, the second pillar, or growth opportunities as some might refer to it, are funds that are focusing on companies making the transition from brown to green. So often these funds invest in more value-oriented sectors such as materials, energy, and utilities that may not be included in the opportunity set for more traditional ESG funds. And lastly, the third pillar, impact. Strategies that are classified under here invest in companies that strive to bring about positive changes in the world. So if you think about it, just bridging the previous slide with this slide, first of all, you can choose from two paths, which is return risk or values and preferences. And the way that these objectives are implemented will be the four buckets that you see, either through ESG integration, using a thematic focus, developing a transition style, or picking companies that are striving to bring about positive changes. And then if you move on to the left-hand side, just to clarify too here, and for everyone to know that these labels are not mutually exclusive. Funds that are implementing a certain theme may also have ESG integration as part of the process. So dual objectives funds often include numerous approaches in their to deliver their objectives. So that's why you see that ESG integration is overlapping with impact, thematic, and transition. Okay, we believe that this classification will help clients better identify funds that will align with their investment objectives and perhaps their values and preferences. Next slide, please. Now going on to the portfolios themselves. Since the launch of the ESG portfolios in 2021, we have seen a healthy growth in the number of ESG-focused funds made available to retail investors in Singapore. And in many cases, we have worked with the fund managers to launch Sing Dollar share classes so that we can offer them in this set of updated portfolios for retail investors. For this change, we have added a number of funds. On the equity side, we added 2 funds from GSAM or Goldman Sachs Asset Management, 2 from Stewart Investors, 1 each from Nordea and KBI. These funds are also available on a standalone basis on FundSmart. And the same thing for the fixed income funds that you see on the right. There are 3 of them that we added from Allspring, eSpring, and the PIMCO ESG Income Fund. Many of you are already familiar with the PIMCO Income Fund. This is the PIMCO ESG Income Fund. So this has an ESG focus and objective. Next slide, please. On this slide, next slide. So we're going now into the actual changes that we're making. On this slide, we summarize the benefits and advantages of the new ESG portfolios into 4 main takeaways. The first that you see on the left, manager diversification. We talked briefly about this already in the previous slides. With the new strategies now available, we are able to construct more robust portfolios with more nuanced asset allocation. For example, in the current ESG equity portfolio, we have only 3 funds because that we believe are best in class at that point in time. And they're actually all global equity funds. So now that we are able to have funds that are more focused on Asia or EM, we can have more nuanced asset allocation models. Number 2, the second key takeaway is a balanced equity exposure. What this essentially means is that the sector and geographical exposures of the equity portfolios are a lot more balanced relative to the global equity benchmarks. There is less concentration in certain sectors because some of the for example, Article 9 funds, ESG focused funds tend to have more investments in asset-light sectors. These asset-light sectors are information technology or consumer discretionary or even communication services because they tend to emit less carbon. So often you will see these concentration in these sectors for ESG funds. But we're trying to reduce that concentration here in this new set of portfolios. So while the current ESG equity funds, portfolios were built with best-in-class funds, they were also very growth-focused. From conversations with our clients, it appears, and it became more apparent to us that we should develop a portfolio that is more style neutral, sector region neutral, that can weather different kinds of market environments. So in a word, these are more resilient portfolios. The new portfolios are more resilient. On the fixed income side, the resilience comes about from an increased allocation to higher quality rated investment grade securities. Investment grade securities tend to be less volatile and tend to have lower rates of default. So Yulin will go more into that when she comes on to present. And the last bit here, lower costs. All of the above we've achieved at a lower expense ratio. And we are very proud that we were able to work with our partners to get the lowest available fees for our clients for these different funds. Next slide, please. And in order to create a balanced portfolio and the balanced profile, we already talked a little bit about that, we removed the Schroders Climate Change Fund and lowered the allocations to Mirova and Global Sustainable Growth Fund, the Schroders Global Sustainable Growth Fund, as they were quite growthy. We added the KBI Infrastructure Fund, which has a strong thematic focus. The GSAM funds are enhanced index funds with ESG screens and filters, and they help the portfolio maintain a closer alignment with its benchmark, the MSCI equity. The Nordea and Stewart funds were added because we believe Nordea and Stewart to be some of the strongest managers in terms of sustainable investing and implementation. As you can see, the new portfolio is a lot more nuanced and has a lot more different flavors. Next slide, please. This is a little bit more complex, so I'll just talk you through it. What the 4 key takeaways that we've mentioned previously mean is that the essential part of that is that the tracking error versus the broad equity benchmark or index is smaller for the new portfolio. Tracking error is a measure of how much an investment portfolio differs from its benchmark in terms of returns. A low tracking error means the portfolio is performing much more like or very similarly to the benchmark. And on this slide, the blue dots are the excess returns of the current equity portfolio. And the yellow dots are the returns of the new equity portfolio. And you can see that the yellow dots are actually a lot closer to the middle than the blue dots. There are a lot more outliers for the blue dots than there are for the yellow dots. So it just means that the new portfolio tracks a lot closer to the benchmark. Next slide, please. Here, this slide is a geographical representation of the allocations to the different regions. The median blue bars represent the new ESG portfolios, and you can see that they are a lot more similar in magnitude to the light blue bars representing the benchmark. And the dark blue bar is actually the current portfolio. We found during the portfolio construction process that there was an overweight to Europe for the current ESG portfolio. We wanted to make it a little bit more balanced. So we took down that overweight and put more into the Americas and Asia, just to align it more like the benchmark. And these are all the changes that I wanted to highlight for the equity section. Yulin will now take you through the changes for the fixed income portfolio. She will also go over how these new portfolios continue to deliver alignment with environmental and societal goals. Over to you, Yulin.
Thank you, Min, for that insightful overview of the equity component. And now let's delve into the enhancements we have made to the fixed income portion of our ESG portfolios. So to start, this slide, similar looking to the equity one shown before by Min, illustrates the improvement in manager diversification and portfolio structure of the fixed income component of our ESG portfolios. So our approach now includes a broader array of fund managers and a more balanced set of building blocks. Two new fund managers, Allspring and Eastspring, are added, and this further reduces the reliance on any single manager. The new portfolio now consists of three building blocks, and these are global investment grade credit with two funds inside, forming an anchoring position of the portfolio, followed by flexible bond managers, again with two different funds inside complementing each other. And finally, a moderate allocation to Asian bond fund to diversify away from mainly developed market exposure. By integrating a wider selection of managers and funds, we have created a more balanced and resilient structure, and this change is fundamental to achieving long-term stability and consistent performance in the fixed income investments. Moving on, again, this is a very similar slide of tracking arrow to the equities one, so I won't go into details. But as you can see from the narrower purple band, which represents the tracking arrow of the new ESG fixed income portfolio, this is narrower compared to the blue band. So the new ESG fixed income portfolio also boasts a slightly lower tracking arrow compared to the current portfolio. And what it means is that on a month-to-month basis, investors can expect on average smaller deviations of the portfolio's performance versus the broader fixed income market. And therefore, the portfolio's overall risk and return expectations are now more aligned with the broader fixed income market. We did find it challenging to reduce the tracking arrow further for fixed income component because of limited options available for the Singapore dollar retail market. The overall portfolio will still be tilted to more credit compared to the benchmark, but we have meaningfully improved the credit quality for the new version, and I will elaborate on this in the next slide. Next slide, please. So for this slide, let's focus on the left-hand side bar chart first, as it highlights the improvement in credit quality of our new ESG fixed income portfolio. The blue bar in the middle represents the sector allocation of the new ESG fixed income portfolio, and the dark bar represents that of the current portfolio. One of the key changes highlighted here is the reduction of high yield exposure and a corresponding increase in the investment grade credit exposure. And this has led to an improvement in overall credit quality of the portfolio. As you can see here as well, and as I have mentioned before, one tilt the new portfolio continues to have versus the benchmark, which is the shaded light blue bar on the right, is its overweight position to securitized credit and corporate credit, and underweight position to government bonds. However, despite reducing high yield exposure, we have managed to maintain an attractive level of yield and an intermediate duration level, as you can see from the right-hand side table. And this balance ensures that the portfolio remains competitive in terms of returns expectations while effectively managing risk. By diversifying across different sectors and focusing on higher credit quality, we aim to offer a more resilient and reliable fixed income investment option in the ESG space. Next slide, please. On this slide, we are very excited to announce a reduction in fees across all 6 asset allocations of our ESG portfolios. And lowering fees, as some of you might know very well, is a core part of our commitment to providing value to our investors. The fee reductions range from 0.33% for the ESG equities portfolio, which is the most left-hand side, and 2.46% for the ESG fixed income portfolio, which is the top right, the most right-hand side. And this reduction in fees directly benefits you by lowering the overall cost of your investment, which can significantly enhance net returns over time. By making these adjustments, we are ensuring that our portfolios are not only high performing, but also cost efficient. Next slide, please. So finally, on performance comparison, this slide compares the performance of the new portfolio to the current portfolio for both equities and fixed income. As you can see, the new portfolio configurations have shown improvements in performance metrics. For equities, the new version's historical return at risk is shown to be much more in line with the benchmark. The new portfolio also boasts higher historical return and lower volatility versus the current portfolio. On the fixed income side, the adjustments in sector allocation and credit quality have led to a more balanced and higher performing portfolio. On a 3-year basis, historically, the new portfolio has been slightly more resilient than benchmark while being of similar level of risk. So now that we have covered how the portfolio changes have brought further alignments of performance expectations relative to the broad market benchmarks, it is important to note also that the portfolio continues to align with investors' environmental and social values. Can we go on to the next slide, please? And yeah, so I will cover this section where we have prepared some data points using the ESG equities portfolio to showcase this point. Next slide. So firstly, this chart compares the portfolio exposure to involvement in a range of products, services, and business activities versus that of the broader global equity market. So how do we interpret the data numbers here? To illustrate, for example, the 1.7% exposure to nuclear energy means the portfolio has 1.7% of the underlying holdings that have meaningful direct or indirect involvement in nuclear energy. Compared to the broader equity market, you can see here that the new ESG equity portfolio is more aligned with a broad array of ethical and social values. For example, it does not invest in companies that produce alcohol and tobacco. It has no exposure to controversial weapons, casinos, and to companies linked to genetically modified products and pesticides, both of which are known to have negative environmental consequences. Next slide, please. In addition, the ESG equity portfolio also has a lower carbon risk score and lower historical fossil fuel involvement. It means that the portfolio is better positioned to transition to a low carbon economy. Next slide. Finally, besides stricter exclusion, lower carbon risk, the portfolio is also more aligned with the United Nations Sustainable Development Goals. For those who are not familiar, the Sustainable Development Goals are an international framework put forward by the United Nations as a call to action to end poverty, protect the planet, and improve the lives and prospects of everyone, everywhere. And the chart here lists the Sustainable Development Goals and compares the average revenue exposure across the ESG equity portfolio's holdings with that of the equity market benchmark. And the portfolio has more exposure via its revenue to areas with positive impact as defined by these goals compared to the broader equity benchmark. So, after looking through the recommended portfolio changes and understanding its alignment, further alignment to performance expectations and also continued alignment with the sustainability objectives, I will go through the steps to guide you to opt in for this recommended portfolio change. Next slide, please. And so how to opt in? Firstly, on timeline, essentially from now till maybe this afternoon, an email will be sent to you if you already have an ESG portfolio with us regarding the recommended portfolio change today. So you can go in and look at it. There is no deadline as to when you should be accepting it, but we strongly encourage you to click in and accept at your earliest convenience. Next slide. You could also access the ESG portfolio change by logging into your account and clicking on the notification bell on the top right corner. The platform will display a comparison of the existing portfolio allocation and the updated portfolio allocation. So you can choose to accept or reject the recommendation. If you reject the recommendation but subsequently change your mind, you can always come back to modify your choice through the Manage Goal button on the respective goal page. Next slide. And once the recommendation is accepted, the portfolio will be rebalanced accordingly. And how it works is that the units of the old or overweight share classes will be redeemed, and proceeds from the redemption will then be used to invest in units of the updated share classes. The entire process will take 5 to 10 business days to complete. While the rebalancing is in progress, you may still continue to invest in and partially redeem funds from the portfolio. However, a full redemption cannot be performed until the rebalancing process is completed. So to wrap up, these updates to our ESG portfolios reflect our ongoing commitment to providing you with investment solutions that are not only aligned with your values, but also designed for long-term success. Thank you for your attention. And now let's move on to the Q&A session where we can address any questions you might have about these changes.
Hey, Yulin, I see that there are actually quite a number of questions. So I was wondering, maybe because you covered the performance section, you might like to take this one. The question is, how has this new 60/40 portfolio performed in 2022?
Right. Yeah, so I need to look at the numbers, but in 2022, it was actually a double whammy for both equities and fixed income. So I expect that the 60/40 portfolio will be down because it is 60% in equities and 40% in fixed income. And can you give me a few minutes to check its performance against the benchmark? And then I'll come back with more comments.
Yeah, and I can actually add a little bit to that as well while Yulin checks the actual numbers. In 2022, the 100% equity portfolio actually outperformed the equity benchmark. It declined by 18.6% versus 18.9% for the index. And the fixed income portfolio also outperformed the benchmark. So, if you do the 60/40, it means that the 60/40 will probably have outperformed the 60/40 benchmark as well.
That's right.
Yeah.
Yeah. No, I'm just looking at the numbers and you are exactly right. And maybe just to give a bit more colors. So if you look at how the new portfolio has performed, and both fixed income and equities have outperformed the benchmark. And I think it's pretty remarkable on the equity side because the previous version had a growth tilt. So if you look at the older version of the equities portfolio, it actually underperformed the benchmark because of its growth tilt, which was hurt in 2022. But by moderating that style tilt and also sector tilt, because I think energy performed quite well in 2022, and if ESG portfolios generally don't have exposure to that sector, it would have been hurt. The new portfolio actually performed much more in line with the benchmark. And on the fixed income side, I believe that the key contributor to outperformance in 2022 was the shorter duration positioning.
Sounds good. Thanks, Yulin. The second question is, does the portfolio contain impact funds? So I can probably take the equity portion, and Yulin would add her comments for the fixed income sleeve. for the equity side, we believe that there are some funds that there is one in particular that would fit under the impact frame definition as defined by our own framework, which is investing in companies that are striving to bring about positive changes in the world. The Nordea Global Stars has a dual objective, which is to create impact, but also to make sure that you are not sacrificing performance while delivering that impact. Yilin, what about the fixed income side? Do you want to add your thoughts to it?
Yeah. So first of all, I think the definition of impact funds is not. It can be quite gray, depending on how you think about it. For the fixed income side, there is an impact portion in that some of the funds have a tilt or preference to invest in climate-linked bonds, like green bonds. And generally, people can consider that as impact investments because you know that the use of proceeds of those investments will be directly into projects that is contributing to climate transition or climate risk mitigation. But that is, I don't think there's any single fund that only focuses on that because then it becomes quite a narrow universe. There is just part of a sleeve, for example, of the PIMCO Climate Bond Fund that really invests in companies that issues that kinds of bonds. Whereas the others, they have some of exposure to green bonds or social bonds, but overall, I think it's more of the integration approach across the fixed income managers.
Great, thank you. There is a question on how does I guess this is referring to the equity portfolio. How does the equity portfolio compare to an ESG ETF like SDWD? I think SDWD is a ticker for MSCI equity screened ESG.
Yeah, MSCI ESG screened. Sorry, it's iShares MSCI World ESG screened ETF. Maybe I can start answering this question, and Ming, you can add on. So just to explain a little bit what this ETF does is that it actually tracks an index, and this index is MSCI World ESG Screened Index. And the methodology of this index is mostly exclusion-based. So it excludes certain sectors that's very common in any fund manager's exclusion list. So we have talked about controversial weapons or fossil fuel related activities and UN global compact principles. So companies that's kind of going against humanity principles. Yeah, and I think this is just one part of what our ESG portfolio does, which is exclusion. As we have mentioned that our ESG portfolio adopts a much more nuanced and holistic ESG framework that goes beyond exclusion. That's the first thing I want to say. And the second thing is this is purely an equity investments, whereas our portfolio is designed such that it is multi-asset. There's different combinations of fixed income and equities such that we can actually align with your risk tolerance after understanding it. Anything to add, Ming?
No, I think you covered everything. I think it's a really good explanation. So just moving on, because we have quite a bit of questions. Let me just see. There's one on the current portfolios, and I can take this one. I believe some of our colleagues have already answered this question, but just for broader understanding, the current portfolios are more growthy. The question is, now that rate cuts are coming up this month, should we hold on to the current portfolio? So that's a market timing question. There's people are foreseeing that there's 75% chance that rate cuts will be coming this year. So that's 25% chance of maybe the rate cuts are not coming. We don't know. We don't know if that percentage is going to change. I mean, that has fluctuated over the past few months. But we believe that these portfolios are more resilient in different market environments. Growthy, there's nothing wrong with growth portfolios. They do very well in growth environments, but they can also do well when, the growth stocks are out of favor. But by investing in a portfolio that is more resilient, more style neutral, I believe that you save yourself the hassle of trying to time the market and guessing whether there's going to be a rate cut or a rate hike. It's just, you just sleep easier at night. Anything to add, Julin?
Yeah, I think another thing is that these portfolios are designed for long-term investment horizon. So instead of being focused on what's going to happen in the next 6 months, 1 year, and how the portfolio will react to it, it is important to actually invest in a well-diversified portfolio that can give you good long-term investment results. And we believe that actually the new portfolios are designed to increase the probability of success for this kind of investment objective. And to be honest, I don't think there is a very clear correlation between rate cuts and the performance of growth and value stocks, because there are a lot of factors at play. So I would encourage one to think twice if one is tempted to do so.
Great, thanks, Yulin. The other question is, are the ESG portfolios ESG only because of the fund selected? What is your ESG criteria for fund selection? I don't know if you want to start off first, Yulin, and then I can add to it.
Yeah, sure. I think fundamentally what we are offering is we have selected the funds that are managed by fund managers with very robust ESG assessment framework, integrating ESG factors and engaging with the companies on ESG issues. So I would say yes, these ESG portfolios are fundamentally ESG because of the funds, the differentiated funds that we have selected. And as how do we select ESG funds? We actually, like what Ming mentioned, we have an ESG framework that we use. So we would assess what the fund managers say and where they fall on the spectrum of ESG approach. Are they more towards the ESG integration side, or are they more thematic or more impact oriented? And then we will assess their ability to deliver what they say. What are the resources that they have at their disposal? For example, what is the ESG committee structure? What is their ESG team, and how well versed are they in all different kinds of issues, and how ingrained is this mindset amongst the team? A lot of factors that we look at. We actually have a very comprehensive due diligence questionnaire that we send to all the fund managers, and there is a dedicated ESG section on it. And if it's a fund with ESG objectives, we would actually spend extra time grilling them on that part of their process.
Yeah, thanks, Yulin. And just to add to what Yulin has said, also we have ESG checklist scorecard for each different approach. So if the fund manager is incorporating ESG for the sake of risk mitigation, we have a different checklist. How are they integrating it? Is this team separate from the investment team? Does the ESG team report to the PM? It's just, there are different things to think about. So we have different criteria for different approaches because we don't want to use the same yardstick to measure different people. So yeah, it's too much to go into it for the webinar, but please do reach out to our client team and we'd be happy to have a session with you separately just to explain this. Maybe just moving on to the next part. There's a question that's been upvoted multiple times. Can you advise what is the kind of allocation we should apply for ESG portfolio in the core satellite strategy? You want to take that one first, Yulin, and I can add on?
Yeah. To be honest, I think from an investment perspective, both, the ESG portfolio is considered to be a core portfolio. So it can form a meaningful part of your overall long-term portfolio because it's now really diversified. There is quite little style tilts, regional tilts, etc. And in terms of how to balance it with other core portfolios, I think it really depends on your conviction in ESG and your personal values and preferences. If you are, a firm believer, you can go all in with your core allocation. But if you are just trying to test the water a little bit and understand how it works, it doesn't hurt to have a little bit in ESG and see it grow over time.
Yeah, that's based. I think that really depends on personal preferences. I can give you an example from my own portfolio. I would probably replace the core a part of the portfolio with an ESG equivalent. So this is something that you'll have to consider whether that is something your investment objectives align with. There's another question. How do we measure the effectiveness of the portfolios in terms of ESG? I can start off first, Yulin, and then maybe you can add on.
Sure.
So Yulin actually has gone through some of the metrics that we look at. There are a few different, so each fund, depending on the approach that they take, would have a different scorecard, and then we will assess that separately. But overall, as a portfolio, we do look at a few things. First of all, the alignment with the UN SDG goals, the product involvement, that really focuses on the exclusion. Are you really excluding everything that you say you are? And also the carbon emission and the trajectory. We want to make sure that we are seeing as time goes by, and of course, this is all historical, not really a snapshot, so you need historical data as well. You want to see the carbon emission going down for the portfolio if that is one of the objectives of the portfolio. Yulin, you want to add to that?
Yeah, I think that pertains the initial selection and assessment of the funds. We also monitor the fund managers on an ongoing basis. Right? We have update calls with them to see what progress they have been making on the ESG fronts, how have they been evolving their own framework, because there are a lot of issues in ESG that's ever evolving and is still debated as of now, and there isn't a coherent and standard framework as to how one should be implementing ESG. So I think we also partner alongside them, and if there is any red flags, we would actually act as we would enact our fiduciary duty on behalf of our clients and advise our clients accordingly. So it's not just quantitative. I think there's a lot of qualitative ongoing assessments that need to happen as this space evolves further.
Okay, there's another one. And this is more focused on fixed income, so I'll let you take this one. What is ESG investing in fixed income? Do you just buy bonds from ESG companies?
Yeah, that's a good question because fixed income is a bit more complicated. I would affirm you that you are partially right. You buy bonds from companies considered to be more responsible, but that is more limited in the corporate space. So corporate issuers and fund managers will assess the risk and opportunity, ESG risk and opportunities for those issuers, and they would rate the companies. The process is very much similar to how an equity investor will look at companies. But there are some other areas of ESG investment in fixed income, like how do you invest in government bonds, securitized credits, etc. So actually the fixed income managers have come up with different frameworks in different sub-asset classes in fixed income. For example, for government bonds, they look at the sovereign risk, right? Especially for emerging markets, governments, like how are they treating their own citizens, any human rights violations by the country's government, etc. And in terms of the securitized credit, a big part of it, for example, is the muni bonds and also mortgage. And in that, there's actually a lot of ESG opportunities as well. For example, providing affordable housing and issuing mortgage on that. And in muni, it's about building infrastructures. So how sustainably are the projects being done is one factor to consider, for example. So it's really down to the specific fixed income asset classes, and we will look at how comprehensive the fixed income managers have for the ESG assessments in these different segments.
Thank you, Yulin. Next question, I can try to answer this one. Traditional energy sources like fossil fuel are crucial for the well-being of people. Should we not exclude them completely then? That's a very relevant question, and we do believe that is very valid. And that's why we consider the third pillar in our classification, which is transition. So these are actually funds that are invested in traditional energy companies that are trying to make themselves more sustainable by looking for alternative energy sources, while at the same time trying to make sure that their operations are a bit more sustainable. So these are all really helping. So while still giving you the energy source that you need, they're trying to make the planet greener as well. And we do incorporate these kinds of strategies in the portfolio. But of course, it's a portfolio that's supposed to be catered to most people's preferences and needs. So if you want to just invest in transition funds, we have a bunch of those on the platform. So please do take a look on FundSmart. The next one, go ahead, Yulin.
Oh, I'm just gonna answer the benchmark because it's a fairly easy question. For equities, we use MSCI All Country World Index. It's a very diversified global stocks index that covers both developed market and emerging markets. And for fixed income, we use Bloomberg Global Aggregate Index that's hedged to Sing dollar because the portfolio is in Sing dollar.
Yeah. And for the purpose of this presentation, we are actually using the iShares MSCI ETF to get the data. Aside from funds invested in, how do you manage the portfolio to achieve your sustainability targets? And what targets are these, please? I can try to maybe answer the question, and I think Yulin, you can add on too. So the portfolios, they don't actually have a sustainable target. What we're trying to do is to allow people to invest well, so similar to an MSCI equity, but at the same time produce some kind of positive change or have maybe some transition, helping out companies that are transitioning. So these are all embedded in the portfolio, but there is no separate sustainability target. Yulin, would you like to add to that?
I think you're right. We are managing this primarily as an investment portfolio. So this will be the same approach as how we kind of manage other portfolios, but the funds inside is different. So I'm not sure whether you have heard about our SPA approach, systematic and passive asset allocation. We do top-down and bottom-up. So top-down will be very similar in that we do strategic asset allocation for long-term. We don't try to time the market, but the bottom-up here will be quite different in that we choose funds with sustainability objectives.
And I believe that was the last question. So thank you so much, everyone, for joining us today during your lunch hour. We hope this session was helpful. This is also available as a recorded version on YouTube.
Yeah, thank you so much for joining us today.